Hello, everyone, and welcome to the final week 4 live chat, which means it is the final set of final project tips. So lots of finality going on here. These are the last tips I have on the final project. Hopefully you are putting the finishing touches on that by now. And here are some additional thoughts, mainly related to the fourth part of your project. So here it comes. Of course, by now you know the overall topic is the 2007 through 2009, or I just aim down the middle and call it the 2008 financial housing market crisis, and then the ensuing Great Recession. This entire project, of course, this essay, is due on the last day of the course, which is next Sunday at exactly 11:59 p.m. Eastern Daylight Time here in the United States. You'll notice the project instructions do recommend they state a PowerPoint presentation. I've actually made that optional. So if you do the PowerPoint, fantastic. If you do a good job, it's worth up to 10 extra points. However, the most you can score for this or any assignment is still 100%. So if you need an extra boost, go ahead and do the PowerPoint. Just do a good job with it. Also, two more things you need by the end of the course. The final exam, don't forget about that. That's a big part of your score. And also, do not overlook the post-test. Go ahead and do both of those. The post-test is the same exact pre-test you took at the beginning of the course, but this one does count a little bit towards your final grade. It counts for 5%, so do not skip those two items. Also, by now, you know your final essay, your final project is broken up roughly into 4 sections, and we've been covering one section every week. So now it is time to cover the fourth and final part of your final project. And here are some thoughts on that fourth part, which states you will examine the legal and ethical issues arising out of the moral hazard, that's a key phrase, arising out of the moral hazard present in the banking and financial sector. You should pay special attention to the decisions or to the decision that allowed investment bank Lehman Brothers to fail even though other banks received government bailouts. Let's explore some details around this. Some key points to cover. Let's start with context of the Lehman Brothers collapse. First of all, the collapse of Lehman Brothers was a pivotal event during the 2008 financial crisis, marking the largest bankruptcy filing in the U.S. history at that point in time. The regulatory environment prior to the collapse was also a contributor. Prior to the collapse, the regulatory environment was characterized by deregulatory measures, such as repeal of the Glass-Steagall Act, which previously had separated investment banking from commercial banking. The Securities and Exchange Commission, or SEC, and other regulatory bodies faced some criticism for their inadequate oversight, which leads us into a discussion of moral hazard and ethical issues. The expectation of bailouts potentially fostered moral hazard, which incentivized financial institutions to engage in riskier practices with the assumption that losses would be covered by the government. The government bailouts raised significant ethical concerns regarding equity and the differential treatment of various financial institutions. Lehman Brothers as an exception. Unlike other financial institutions during the crisis, Lehman Brothers was not offered a bailout, which prompted widespread debate over the criteria used to determine which institutions, which banks, were deemed quote-unquote too big to fail. There were several impacts resulting from the failure of Lehman Brothers. The failure of Lehman Brothers had a cascading effect on the global financial market and was followed by a severe economic downturn and subsequent policy reforms, including the Dodd-Frank Act, which aimed at preventing a similar crisis in the future. The government and regulatory bodies' decisions during the crisis reflect a complex interplay of protecting the financial system's integrity while also grappling with the consequences of moral hazard, which we will explore that term in more depth momentarily. Arising from all of this was an educational imperative. The analysis of Lehman Brothers' collapse and the subsequent bailouts of other banks provides a foundational understanding for future financial leaders, that could be you, to manage financial institutions ethically and prevent systemic risk. Let's take a closer look at this concept and definition of moral hazard. Moral hazard is defined as the situation where individuals or entities are more likely to take risks because they do not have to face the full consequences of their actions. This term is frequently applied in the context of the banking industry and financial markets in general. Within the banking industry, moral hazard occurs when financial institutions engage in risky behavior such as speculative investing or lending with the funds that are deposited and entrusted to them by their customers. The underlying assumption for such behavior is that any potential losses incurred from these risks might not be fully borne by the banks themselves due to protective measures like government bailouts or insurance systems. There are, of course, a number of negative implications for stakeholders. This dynamic has implications for depositors and the broader financial system, as it can lead to excessive risk-taking that jeopardizes the security of depositor funds and could potentially destabilize the entire financial system. Next, let's consider examples and precedents. Historical instances, including the actions leading up to the 2008 financial crisis, have demonstrated the real-world consequences of moral hazard, where the expectation of government intervention allowed for riskier behavior by some financial institutions. Let us now examine risky mortgage lending practices. Prior to the 2008 financial crisis, banks extensively engaged in risky mortgage lending practices. This included issuing a substantial volume of loans that had a high probability of default. A significant portion of these risky loans were subprime mortgages given to borrowers with poor credit histories who were unlikely to repay their loans. These mortgages were characterized by higher interest rates and were more prone to default. This led to securitization of these risky mortgages. The high-risk mortgages were often bundled together and sold as mortgage-backed securities to investors. The process of securitization spread the risk of default to a broader market. Banks were aware of the inherent risks associated with these loans. However, there was a prevailing belief that the industry was, quote-unquote, too big to fail, implying an expectation of government intervention in the event of a downturn. The assumption that the government would provide bailouts to avoid a financial crisis was widespread among various banking institutions. This expectation influenced the bank's decision-making processes, leading to an increased tolerance for risk. Consequently, bankers were inclined to avoid taking full responsibility for the outcomes of their risky decisions. The belief in potential government bailouts mitigated their perceived personal and institutional risk, essentially clouding their judgment. The decision to bail out financial institutions during the financial crisis was heavily influenced by the size and systemic importance of those institutions. The prevailing belief was that the failure of such entities could lead to widespread instability within the financial system. The failure of the largest banks was perceived as a potential catalyst for systemic failure, which was deemed to be too catastrophic for the global financial system. Such failures were believed to be capable of triggering significant economic downturns with global repercussions. Lehman Brothers can be viewed as a case study. The collapse of Lehman Brothers exemplified the reality of the too big to fail doctrine. Despite being a major investment bank with a significant global presence, Lehman Brothers did not receive a government bailout. The downfall of Lehman Brothers set off a series of failures within the banking sector and proved to be a critical point in the global financial crisis, underlining the interconnectedness of the banking and finance network. Let's examine the systemic importance of Lehman Brothers. Lehman Brothers was not deemed systemically important enough to receive a bailout. The institution was primarily an investment bank, which differs from commercial banks that have a broader consumer base. The client base of Lehman Brothers largely consisted of institutional clients and high net worth individuals, as opposed to commercial banks, which serve a wide consumer base and small businesses, which is a distinction that factored into the decision-making process. Political and legal backdrop. The U.S. government faced substantial criticism for the bailouts of other financial institutions. There were significant concerns regarding the political backlash from continuing to support failing financial entities. This brings up the topic of legal constraints on bailouts. There were legal constraints limiting the government's capacity to bail out Lehman Brothers. The existing laws did not provide the authority to offer the direct support needed to rescue the bank. This slide contains a list of suggested references for you to locate. If you've not already done so, visit keiserlibrary.com. Get to know the EBSCOhost and ProQuest databases and search for journal articles and other suitable sources to support your writing as you complete this project. This concludes our live chat session. If you are participating in the live session, we have some time for questions and answers. If you are playing back the recording, please call, text, or email me with your questions, or post your questions to the Ask Questions discussion board for the current week. In the meantime, see you online.